Hello, my friends. Brett Pattison with Iron Gate Global Advisors, coming at you from the financial capital of the West. That, my friends, is Salt Lake City, Utah. Thank you for taking a few minutes of your time today to understand a few things about the market, including the question we have posed there right in front of you. Will 2016 be another 2015? 2015 was kind of a stinker. As far as market performance, let's do a quick recap of 2015. Here's your global markets. The S&P 500 eked out a positive return, although it fought like crazy to be negative. It actually turned positive towards the very end, 0.81%. The leader, as far as the global markets, the developed non-U.S. down. That's Europe, that's Asia, down almost 4%. The emerging markets were just hammered, down almost 18%. And then the MSCI All-World Index, that is used as a benchmark for many of our clients and many of those listening today, down 2.48%. That MSCI is kind of a hybrid of all three of those above it: U.S., developed, non-U.S., and emerging markets. But all of the global markets had a flat to down year. Not great. Not great when you're trying to build wealth. But we know over the long term that 1 year is not going to destroy a plan. And if you do things right and prepare yourself in the proper way, you'll be just fine. And that's what we're going to address today. Before we do, here's how the sectors did for 2015. The returns there on your right, a couple to highlight. We've got stars by those sectors that we are overweight, or at one point were more overweight, right? And maybe we adjusted it throughout the year. But those sectors that have stars are those that we've been more overweight. Consumer discretionary led the year at 7.26%, while energy was just demolished, down 24%. Please note that where we have stars and what we talk about is over and underweight are not recommendations in any way, shape, or form, so keep that in mind. But nevertheless, I think we did pick some good areas of the market in terms of discretionary and staples. Financials struggled, down 5.5%, although I love financials moving forward as well as industrials. And we'll be producing more content as it relates to maybe energy. Energy down 24% presents an interesting opportunity as far as value goes. The question is it the right time to invest? And we'll be answering that type of question over the next month or two to come. But 2015 recap, it wasn't a great year, right? It wasn't a great year at all. But again, we know that it's 1 year does not dictate or derail or produce ending results for what can be a 5, 10, 15, 20, 30-year plan. All right, that's an important concept. Also, as a reminder, as we actually start the conversation, round out 2015 and look down to 2016, and we brought this up in the last presentation, the last market commentary that we did, it's our process for investing. I won't spend a ton of time on it, but understand that it's process-driven, not results-driven. We focus on the probabilities of making money, and we look at what's happening in the market, and we build kind of our own internal distribution curve, right? What are the probabilities telling us based on what we're seeing in the global markets, based on the facts that we have, and based on our ability to value investments. And then we build portfolios based on those probabilities. And you've got to understand that to every distribution curve, there's always tails, right? And so it's also a matter of managing the risk in those tails at the same time you build these portfolios. In case in point, we talked about in our last market commentary the Santa Claus rally, which is an 80% probability that the market the last 7 trading days which occur after Christmas. So after Christmas into the second trading day of the year, which is today, we know that the market averages a 1.6% return and about an 80% probability of getting positive to 1.6%. And the reasons are there, and this is the same slide I used last month. The problem was that we didn't average a 1.6% return this time. We averaged a close to a minus 1.6% return, right? So just because the probabilities tell us something is going to happen doesn't mean it's going to. Nobody's perfect, and we admit to that. However, very proud of what we've been able to accomplish even with that in mind, and I'll share with you some results from 2015 as it relates to a part of our portfolios here in a moment. But what I want to talk about is 2016, and what does 2016 bring? And again, it's a simple equation, right? You take X plus Y equals Z, and I'll break that down as to what I mean here. You've got to take a look at everything going on in the world. And what do we have going on in the world? We have interest rates moving higher. We have fourth year of a presidential term / election year. We're coming off of not a great year in 2015, so a flat market. We have China. We have all these other global worries. And so you've got to take all that into consideration and say, okay, when was the last time that these things occurred? X plus Y. And what were the results? Z. And that gives you a good probability distribution, right? That tells you, okay, well, what's the likelihood of something happening based on historical returns, historical numbers, history itself, and then we build probabilities and distribution curves and build portfolios to match that and to take advantage of it. And it's and one of my favorite investors of all time, someone that I look to, a great deal is Sir John Templeton. He said this. He said the 4 most dangerous words in investing is "this time is different," right? This time is different, meaning he's validating the process at which we have, in which we're going to talk about right now. When was the last time this occurred? Because there's one thing that doesn't change, and that's mankind. Mankind, their psychological makeup, it doesn't change year to year, day to day, month to month. I mean, it's the same. People react to certain situations almost the same every time. And so that's why history repeats itself, right? That's why we need to learn from history to take advantage of it. All right, so what does 2016 bring, and what are the probabilities of 2016? Well, we know this. Following a flat year, all right, we know that the subsequent year, the S&P average is right around 12.8%. So if there's a flat year, which is a range of 3% plus or minus, which we had this year, the subsequent year, meaning 2016 or the following year after the flat year, the average is 12.8%, which is pretty good. And in fact, the market, meaning the U.S. market, not the global markets, this is U.S. numbers, rose in price 80% of the time with an average of 12.8%. So think of probabilities here, and this is going back a century, these numbers, all right? So following a flat year. All right, so that's the first thing. The second thing is an election year, right? We're moving into an election year. We're moving into the fourth year of a presidential cycle, which I'm not going to get into, but we also know this. The S&P 500 average is 6.1% during the fourth year of the presidential cycle, which we have now, and the probability is it rises in price about 76% of the time. That's something you're going to be hearing a lot this year, is about this election and about the impacts of the market. The most important thing that you do when somebody brings up the election year and its impact on the market is you've got to go back in history and look at what it's done before. And this is this is what it's done before, an average of 6.1%, rising in price 76% of the time. All right, so I like the probabilities so far. Now, the third thing that we have in 2016 is interest rates. And we've hit interest rates. I've written a number of articles on interest rates, done quite a bit of videos about interest rates and its impact on the markets. And we know, if you've listened to those videos, that it's bullish for the market. Let me just share with you the U.S. returns, average returns for raising rates, right? We know that on average, 3 months after they start raising rates are low, start to go higher, that the average return is 6.3%. Over the 3 months, 6 months, 8.8, 1 year, 9.2. So all of these three things and these three concerns, or these three headlines that we've already seen this year and will continue to see this year, we know it's bullish for the market. Here's one kind of negative thing, right, as it pertains to interest rates. We know that when interest rates start going higher, okay, we get positive returns in the market, but we also get a lot more volatility. And this is from S&P Capital IQ, my friend Sam Stovall. And on the left-hand side, you can see there, actually, let's focus at the top. This is the S&P 500 daily 1% plus move in the market. So how many times did the market move plus or minus 1%? Volatility is down moves as well as up moves. And so it's looking at, on the far left, starting date. Those are all the dates since 67 as to when rates were low and when we started raising them, or when the Fed started raising them, not us, the Fed. The second, kind of the middle column, is the number of 1% plus days before they started to raise rates. And then it is afterwards, it's the how many 1% days happened after they started raising rates, right? So before and after. And it's very interesting that the before, there's not a whole lot of 1% moves compared to after. In fact, out of all those times, you can see the average down there at the bottom, 9.3 versus 16.4. But there's only one time in history, going back to the 60s, that the Fed raised rates and there wasn't more volatility in the market. And that was in 99. Every other time you had more volatility occurring. Look at 87, look at 80, 77, 73, 68. I mean, those are significant moves. Even 67 from 2 to 7. And who knows what we'll end up with now. But again, the key is to understand, okay, what happened the last time we were here, or the last 10 times we were here, right? How did the market react? And we know by history, on average, that there's more volatility. Volatility both up and down, all right? So let's put all this into summary, and those are, that's a lot to throw at you at once. Again, we're building this distribution curve to help build portfolios and to understand risks and to give us a glimpse of what may happen in the market. And we know that just based on the probability numbers, we know that we there's a high likelihood that we're going to be positive on the year. I like that, right? Going after a 2015, which wasn't great. I like the fact that the probabilities are on our side, but we also must expect more volatility than normal. Okay, and so it's important for you all. In fact, I've got some advice. The advice that I would have based on what we're seeing in looking in the rearview mirror is that you shouldn't get caught up in the day-to-day movements of the market. You should have a process that includes probabilities based on market cyclicality, or probabilities based on the value at which you buy an investment, which is probably the most critical thing, right? value and cyclicality. And don't get caught up in the day-to-day movements of the market. If the market's down 2% in one day, like it was the very first trading day of the year, don't destroy a decade plan or a 20-year plan or a 30-year plan or a 5-year plan. Don't destroy that based on that one day. All right? That's very important. The other important part of this is to understand in every distribution curve there is tails, right? And you have to manage the tails appropriately. And so what we do at Iron Gate Global Advisors is we utilize options. And I've been with the firm now for over a year. We've got 1 year under our belts of trading options officially. You can see our 1 year returns there. Our benchmark, which is the SIBO Buy Right Index, essentially covered calls on the S&P 500. You can see that we, after fees, commissions, were 11.93%. Very proud of those numbers, but also realize it was a very volatile year. Something that we can definitely take advantage of in the options market is that volatility. Now, a couple things. If you've got 15% of your portfolio in options, making you near 12%, the rest of your portfolio is roughly flat, then you've turned a flat year into a positive year. That's the power of options. If you want any more information on that, it's not suitable for everybody, but I'm more than happy to have that conversation with you. Email me, brett@igga.com. If you want to see the bigger glimpse as far as those returns go, more than happy to provide those to you. Just email me, brett@igga.com. Visit our website as well, www.igga.com. But very proud of what we've been able to accomplish in the first year. Certainly, I've been trading options a lot longer than that, but the first year under the firm's umbrella is what you see there. Here's our contact information. If you have any questions on what we've discussed today, feel free to email me, brett@igga.com. There is my partner as well, Brian Hunsaker, our value investor extraordinaire. And if you have any questions for him as well, feel free to reach out. We'd love to help you in any way that we can and to assist you in accomplishing your financial goals or helping you sleep better at night or giving you a glimpse as to where you are in preparing for retirement. Or maybe you're retiring next year and you don't know what you're going to do. We're here to help you with that as well. So let us know how we can help you. Until next month, my friends. Thanks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.